And let's broaden the conversation, if we could, with more guests. Stephanie Link of Hightower Advisors, Flynn Phillips of Obermeyer Wood. Steph, a CNBC contributor. It's great to have you here with us on set. What do you make of what the professor has said?
Well, first, it's great to be here. The professor brought up a lot of very good things. I mean, one thing, even with this week, 2024 has been an incredible year. And it's really been so because you've had this soft economic landing, lower interest rates, and really solid earnings in both technology and other sectors. So first, we'd really pause on that. Mm-hmm. The other thing is history has our back. So if you look at presidential time between inauguration days and presidential elections, for the last 50 years, there's only been 2 times when the market's been down. And that was 2000 and 2008. And that was when you already were in a recession and a severe bull market.
How much do you think we've pulled forward, though, because the burst was so sudden and big? Now, it's cooled off, obviously, this week, but we did have a pretty large pop off of the result of the election.
We did, but to us, that was more of a relief rally. It wasn't necessarily an endorsement of the new administration's policies. It was more the fact that you actually had a fair election. You actually now have certainty, which is good. So from that point of view, is we think this pullback actually is quite natural this week. Again, like the market got a little bit rich, we're back to something more normal. Mm-hmm. But the key thing more than anything is picking your spots, finding great opportunities going forward where you have trends that are not based purely on administration, but really in terms of long-term trends and really good companies.
Steph, what do you make of those points of view?
Yeah, I think I agree with a lot of it. I think that, look, the market is digesting what the Trump administration, what does it mean for growth? What does it mean for inflation? And now you all of a sudden have a Fed that's probably going to be much slower in terms of rate cuts. Here we go again, right? I mean, I can't believe we didn't learn our lesson back this past year. When we started in January, everyone was thinking 7 cuts. So we have to just kind of digest that. That all being said, Scott, we're still up 2% in November, both the NASDAQ and the S&P 500. So you're still having a pretty good month. I think that there's a big misinterpretation in terms of the inflation data. I mean, I think, yeah, the core CPI and the PPI in the 3s is not great, but it's because we are growing faster. And I will take faster growth and a little bit more inflation from an investment point of view any day versus the reverse, because that gives companies pricing power and it also helps the margin story. And if you have a mid-single digit revenue growth in a 2.5% GDP world and margin expansion, you can get to 8 to 10% earnings growth for this year and also for next year. So I just think we have to just settle down and realize we're growing faster. We have a little bit more inflation. Maybe the neutral rate is at 4.5%. We can live with it because, by the way, we have a consumer that just won't quit. I mean, those retail sales numbers this morning, if you think about it on a year-over-year basis, running up 4.6%. You had an ISM services number about a month ago, near 60. And this is really a good time for the consumer, even in the face of higher inflation. And so I think, yeah, you want to pick your spots for sure. I love that we're seeing the broadening out. I mean, the Russell 1000 growth is actually down 2% today. The Russell 1000 value is only down 40 basis points. And so you are seeing an expansion into participation. And I like that.